Let's talk about something that drives every trader crazy. You know the feeling? You spot what looks like the perfect setup, you pull the trigger on the trade, and it just fails. Feels like you just have bad luck, right? Well, it's not. I mean, you've seen this a million times. A textbook pattern shows up, everything lines up, you follow your plan to a T, and wham, the market just rips in the other direction. Honestly, getting past this one hurdle is a massive step towards becoming a consistent trader. So here's the thing. The reason those picture-perfect setups fall apart isn't random. It's because the setup itself is like only half the story. The other half, the part that really matters, is the context. We all learn these, don't we? They're the classics. We spend all this time memorizing what a break of structure looks like, or hunting for that perfect change of character. We become really good at recognizing patterns. And so, naturally, when they don't work out, our first thought is, ugh, another fake out, or this pullback strategy is just garbage. We blame the tool. But the tool is fine. The real secret is knowing exactly when and why to use it. So you've got to think of it like this. There are two sides to every trade. You've got the what, the patterns we all learn to see. But then you have the why. Why is the market even moving? It's chasing liquidity. What's the bigger picture? That's your market structure. And when is the move likely to happen? That all comes down to timing. The pros, they live on the right side of this chart. Okay, so how do we start thinking about the why? Well, it all comes down to these three core pillars of context. This is the framework that's going to shift you from just spotting patterns to actually reading what the market is trying to do. And here they are. A really high probability trade isn't just a pretty pattern. It's an event that checks these three boxes. 1. Has the market collected its fuel? 2. Has it shown its hand with a real shift in structure? And 3. Are you playing when the big money is actually in the game? So let's start with liquidity. The easiest way to think about it is like fuel for the market. All that money sitting in stop losses above old highs and below old lows, that's what the big institutions, the smart money, are after. They need to trigger those stops so they can fill their own massive orders. They literally hunt for this stuff. Next up, structure. A break of structure or a change of character isn't just a line on your chart. It's a confirmation. It's the market telling you that, hey, we just took that liquidity and now we're committed to this direction. It's like finding their footprints in the sand. It proves their intent. And finally, timing. A perfect-looking setup that happens in the middle of a sleepy, low-volume session, it's probably just noise. The best, most reliable moves happen when the institutional volume is pumping, and that's almost always during the London and New York session overlap. You want to trade with the current, not against it. Okay, so now that we have the pro framework, let's flip it and look at where so many traders get it wrong. And it really just boils down to one thing. They see a pattern, but they're totally ignoring the story that the market is telling. This right here is the recipe for disaster. You know, jumping into a trade the second you see a chotch, way before any real liquidity has been taken. Or maybe it's taking a scalp on the 1-minute chart that's going directly against the daily trend. That's not trading a process, that's just trading on pure hope. And all of this leads to a huge shift in thinking, a real paradigm shift. It's about understanding the massive difference between something that's just possible and something that's actually probable. This is the key takeaway right here. Any random pattern you spot on a chart is just a possibility. It's a maybe. But it's the context, the liquidity grab, the structural shift, the timing that stacks the odds in your favor and turns that maybe into a high probability trade. Which brings up a really good question. How can two different traders look at the exact same chart at the exact same time and get completely different results? One wins, one loses. Why? The answer is actually pretty simple. The struggling trader is just hunting for patterns. The successful trader, they're reading the context. They're not just seeing shapes on a screen. They're understanding the story the market is telling them. So let's put it all together into a simple, really powerful formula that you can apply to every single trade you think about taking. Look at it this way. A setup with no context, that's just guesswork. It's a coin flip. On the other hand, having great context but no specific setup, that's useless too because there's nothing to act on. It's only when you combine a clear setup with the right context that you find those truly high probability opportunities. If you only take one thing away from this entire explainer, please let it be this. The setups themselves don't fail. Your break of structure strategy isn't broken. What fails is using it at the wrong time, in the wrong place, and for the wrong reason.
And hey, if this was an aha moment for you, if it helped you see your charts in a new way, do me a favor and hit that subscribe button. Because that's what we do here. Every single one of these explainers is designed to give you a clear framework so you can build a professional process. Because at the end of the day, success in this game is about trading with a process, not just with hope.